Hi, this is Jeng, and today we're going to be talking about the impact of your debt on your investor return. So we're going to talk through a case study, just a standard deal, go through some of the inputs, and then basically look at 4 different financing options, and then how that impacts your return as an investor. So let's jump in. So this is a 60-unit deal, built in the 80s, 750 square foot, average, 1 beds are 50%, 2 beds 50% of the unit mix. In-place rent's about $977, market rent's about $50 more. It's a stabilized deal, 95% occupied. It needs about $250,000 in rehab. So the Worcester price is about $5 million. So on the sample deal, I just want to show you guys. So I just sort of plugged in the numbers here. And what's going to change is not necessarily the inputs around the property. So the unit mix, the expenses, projections, that's all going to stay the same. What's going to be different is this box number 1, which is going to be your inputs, which is going to drive your debt assumption. So, in terms of inputs, let's just plug in, current rents, pro forma rents, and then where you think you can get them based on the rent comps. So that's easy. Expenses, sort of your standard expense assumptions. We did 5% for management fee, G&A about $417 a door, which was in line with T12. Payroll about $1,100 a door. Utilities, water and sewer, that's usually T12. R&M about $600 to $700 a door. Insurance is about $500 a door. Taxes based on where it is today, and then replacement reserves about $300 a door. So plug in all your expenses there, and then projections. We used other income based off T12 and where we thought we could take it, and then no rent growth in year 1. But then moving forward, we would do about 2% rent growth over the year 3, 4, 5, and 6. And so this is really the meat of it. This is what we wanted to talk about is once you plug in those assumptions, now your choice is what loan option do I use, right? So there's recourse bank loan, which is sort of scenario 1, Freddie Mac SBL, Fannie is number 3, and number 4 is recourse bridge loan. So let's go through each one of these and just sort of plug in what I think current terms are in today's market. So let's look at recourse bank loan, right? So they're going to go up to about 75% loan to cost, right? Interest rates about 4.75 right now. Years of interest only is typically 1. Amortization 25. They aren't requiring any reserves at close right now, and then your cost of sale is about 2%, right? So when you plug that into the model, your return's about 77% total return, which is good. And some of the advantages, you're sort of getting to roll in some of your rehab. IRR is about 13%, and your total investment's about 1.5 million. And the biggest thing with recourse bank loans that people get hung up on is that they're recourse. So you have to keep that in mind, and is that something that you're willing to take on? All right. So remember that 77% on a recourse bank loan, about 1.5 million initial investment. So let's jump over to the second one. So now you get into non-recourse Freddie Mac. So you have to remember, it has to be 90% occupied for the last 90 days, and the loan amount has to be over $1 million. And so let's plug in some of the assumptions. So right now, non-recourse Freddie Mac SBL is based off of 10-year treasury. So 10-year treasury is very low right now. So we're going to plug in an interest rate of 4%. 1 year of interest only. You can get even more, up to 3, but I used 1 year on this example. Amortization goes to 30-year amortization, right? So in the previous scenario with the recourse bank loan, their max is going to be 25-year amortization. So this is going to help your cash flow. In terms of reserves, Freddie Mac SBL is requiring 12 months of reserves currently, and then your cost of sale. So when you go out and fix a longer term loan, so most people do either 5, 7, or 10-year loan, they're going to have what's called a step down prepayment. And so that starts at 5% and goes down to 1%. But like, let's say you sell in year 5 in this example, then you're still going to have about a 3% prepayment penalty. And then on top of that, any sort of cost of sale for the listing broker or title cost, anything to get the deal across the finish line. And so let's just jump in and put in some of those items here. So on Freddie SBL, we did 75%, which is the same, but 4% on your interest rate. We did 1 year IO, 30-year amortization. And then we did 12 months P&I, and then a 5% cost to sell. So let's do 12% here, and then your P&I payment here. So that's what you're going to put up at close. They're essentially going to hold that for anywhere from 9 to 12 months and then release that once you hit a 125 debt service coverage. So you can see your return drops to about 65%, and you have 1.7 as your initial investment. So it's a little bit lower returning than your recourse bank loan, but of course this is non-recourse. And what's driving that is the reserves that are needed at close and the cost of sale. All right, so that's scenario 2. All right, let's go to scenario 3, which is your non-recourse Fannie. So Fannie, similar, 75% loan to cost is typical in today's market. You can get up to 80% on Fannie and Freddie if the deal qualifies on a 125 debt service coverage. So Fannie, the interest rate's a little bit lower right now. So it's about 3.5%. You're getting 1 year interest only, 30-year amortization. Big thing here, because this loan is under $6 million, they're having you put up 18 months of P&I. So it's a little bit higher in reserves. And then your cost of sale. So typically on Fannie Mae, there is something called yield maintenance. And so yield maintenance is essentially you paying the remaining interest over the life of the loan today when you prepay the loan. And so they take a present value of that. And so it is typically a higher prepayment penalty than your step down prepayment. And so on this example, I used 8% cost of sale. So when you do that, we can plug in all the numbers in the Excel, but essentially what it comes out to is about a 57% total return for you as the investor. Your initial investment is higher, right? So $1.8 million in initial investment compared to before you were looking at, close to 1.5 because of the reserves needed at close. All right, so that's scenario number 3. Scenario number 4 is your non-recourse bridge. And so this one is typically for deals over $5 million in loan amount. On this scenario, I just used sort of your standard assumptions. If this deal was a little bit bigger, it probably would fit. I don't see most lenders going down to $4 million, but just because this deal, wanted to see how the returns compare on this deal. So they can go up to 80% loan to cost. The interest rate is higher, so it's 5.5%. The years of interest only is about 3. So they're going to do IO, the full term, amortization 30 year after that. The reserves, I assume 6 months. So this is going to vary by the bridge lender, but about 6 months is a good number. And in cost of sale, they're usually just going to be a 1% prepay to get out of these loans. So you come up with you have the lowest initial investment, only about 1.4 million. In total return is about 67% on this particular deal. So let's go in summary, right? So we started with the recourse bank loan in scenario 1. It's about 1.5 initial investment, but 77% total return, but it is recourse, and it only has a 5-year term. Second scenario was non-recourse Freddie Mac SBL. So this was 1.7 on your initial investment, 65% total return. This is really driven, that lower return is driven by lower the reserves you have to put up right now and the prepayment penalty, which is step down. But then if you compare that to Fannie, you get non-recourse again, but then your reserves are higher and your prepayments higher than Freddie. So on that one, you have a higher initial investment, lower return. And the last one is your non-recourse bridge. So this is less of an initial investment, and it has a higher absolute return, except against the recourse bank loan because there is reserves, but then also a higher interest rate. And so it's your choice, right? So if you're comfortable with the maturity risk on scenarios, the recourse bank loan or the non-recourse bridge, you can achieve higher returns. But if you're more conservative and want to go with, a longer term loan and just pay the prepayment penalty and not take the maturity risk, then non-recourse Freddie Mac SBL or non-recourse Fannie Mae will probably work better for you and your investors. So, my background is I was born and raised in Houston, went to school in Austin, and been an underwriter for 8 years at G Capital until 2015. And then I've been more of a mortgage broker in the last 5 years, originating over 800 million in multifamily loans across 125 properties, and also invested in 6,000 units across Texas. So if you like the channel, definitely subscribe, join the email list. If you want me to review a deal, get a term sheet for you on your next loan, send me a T12 rent roll offering memorandum. Or if you want me just to review a deal, send me the investment package. I'll go through it, give you my thoughts on it. And so set up some time to talk with me by filling out your personal financial statement and sending me an email. Thanks a lot, guys.